Hey guys, welcome back to Follow Me 11B. Discussions on current events, macroeconomics, and freedom and liberty from a veteran's perspective. Today I wanted to discuss the possibility of the U.S. slipping into recession. I also wanted to examine this through the lens of the yield curve and talk a little bit about the much touted yield curve inversion, which you've probably heard quite a bit about over the last few weeks and months. So let's start with a quick definition of the yield curve. What is the yield curve? The yield curve is a graphical representation of the yield or the interest paid on various U.S. Treasuries such as T-bills, notes, Treasury bonds. And for example, picture a graph. Starts in the bottom, a line graph. And this indicates perhaps a 4 to 6 month Treasury, and it pays 0.25% interest, and it slopes upward. And when it gets to the end of the graph and it hits the top, maybe 2 years in, maybe that pays 1.75% interest. So it pays more the longer you keep it in, the longer that the bond is exposed to more risk. Typically the more interest you're paid, the more yield you receive. There's also a flat yield curve, which is pretty much straight across flat, and the short term and the long term approximately pay the same amount, indicating that the interest rate's going to likely be the same 2 years in as it is 2 months in. And what we're going to talk a little bit more about today, though, which is of concern to a lot of investors and economists, is the yield curve inversion, which starts at the top. Again, a line graph starting at the top. Again, maybe 4 to 6 month Treasury purchase, and that would pay you the 1.75. It slopes down, and then when it gets to the bottom, 2 years in, then it pays you the 0.2%, 0.25%. So it's completely flipped. It's inverted. So now that we've got that defined, let's go to a Bloomberg article I came across entitled "Morgan Stanley Sees U.S. Curve Inversion Coming But No Recession" by Greg Ritchie, March 18th, 2022. It's the end of the U.S. yield curve as we know it, and Morgan Stanley strategists feel fine. 2-year, 5-year, and 10-year yields will end 2022 at 2.75%, 2.50%, and 2.40% respectively. With inverted curves across the entire Treasury space, strategists, including Gunit Dinegra, wrote in a note to clients. Traditionally, that's been a harbinger of recession, though not this time around, they argue. We think markets are learning to live with yield curve inversion, they said, citing the willingness to price restrictive policy rates as well as distortions due to pension demand, QE, and investor flight to quality. The inversion of the yield curve on its own is not sufficient to argue for heightened recession near the recession risk in the near term. History would argue with you about that, but I digress. As the inflation fueling fallout from Russia's invasion of Ukraine continues, investors are closely watching the yield curve for signals on the growth outlook. With Federal Reserve officials projecting raising interest rates as high as 2.8% by the end of 2023, bond traders are growing increasingly concerned that the economy could buckle under the weight of monetary policy normalization. See, that just goes to show the how weak the economy is right now when Federal Reserve officials are projecting a possible interest rate as high as 2.8%, and economists and traders are getting that concerned over a relatively low interest rate. Markets eventually will accept an inverted curve as a natural consequence of interest rate policy moving towards restrictive territory faster than balance sheet policy approaches neutral territory, the Morgan Stanley strategist said. They did not see a shallow inversion noticeably reducing bank loan growth, citing data from previous curve inversions between 2 and 10-year yields since 1969. Since still they see some room for caution in speculative assets. The signal of a restrictive Fed policy embedded with an inverted curve, as well as the risk of an earnings recession, is likely to weigh on stock markets, they said, even if the curve does not signal an economic recession. The Fed, the U.S. economy, the U.S. banking system, and investors can live with an inverted term structure, they said. Discussions of an impending recession will continue, but we expect confidence that in that view to wane over time. Perhaps they should have rephrased that to perhaps they, instead of expect, hope confidence in that view to wane over time. Why do I say that? Well, since the early 1980s, there have been early 1980s recession, early 1990s recession, dot-com, around the year 2000 recession, and the Great Recession. 4 recessions in 40 years. Why is that important? Well, preceding each of those recessions was a yield curve inversion. So if you're a student of history, you may want to reconsider or maybe move money that you've got currently parked or you're considering parking into Treasuries into another engine for potential growth. Perhaps, and typically investors see this as safety, but they invest in other things such as precious metals, gold, silver, platinum, nowadays crypto, perhaps some real estate, which takes some of the firepower out of the yields. So the curve on the downward slope, on the bottom of the slope, is actually a lot less because investors have been pricing the considering the movement of investments from treasuries into other assets, so that they kind of price that into the potential yield curve 2 years from now. Now that said, the yield curve slope that says it goes from here to here. Well, we don't have a crystal ball. It could very possibly go from here to here and level out. But being a student of history, I wouldn't bet on it. As a matter of fact, the way things are going in the Ukraine right now is certainly going to skew the normal result that you could probably figure out from, if the world were operating in a normal manner right now. We've got other QE distortions, we've got stimulus distortions, we've got all kinds of government things that are going on that they're doing to the economy to distort it and to make it not operate like it normally would. So who knows what's going to happen, but my gut feeling is there is over 50% chance of recession. And if I were a betting person, I would bet that, since I believe we're still kind of running on the fumes of the stimulus that is probably running out right now, but still in people's bank accounts, still some of it in people's pockets, I think that we're going to see this recession, if it were to start, probably in the fourth quarter 2022 or the first and second quarter of 2023. So that's my prediction. We'll see if I'm right. Hope I'm wrong, but we're going to have to wait and see. I would love to hear what you guys think, though. Please let me know in the comments. Don't forget to subscribe. And while you're at it, check us out at Follow Me 11B on Facebook, Twitter. Like the page, subscribe, follow us there, and don't forget to also visit us at The Real Follow Me 11B on Instagram. And we will see you all on the next video.